Okay. I thought music could go on for another minute or two. Great to have you guys here. Thank you for having me to Milken Institute. And we've got an amazing panel coming up. And it's such a monster panel, I'm going to say, because we're trying to cover a lot, but that means a lot more takeaway. So I'm not going to waste more time, and I'm going to get straight into it. And I think I'm going to kick off with the usual suspect, the risk sentiment. How are we feeling about Trump, tariffs, potential recession, inflation, all the familiar concerns that we might have? And I think it would be perfect to start with Kevin. Yeah.
Thank you.
I know. How are you feeling about, how is your team feeling about the risk sentiment? Is everyone freezing until April 2nd?
Well, look, it's a pleasure to see everybody. Do I get to cheer people up? Is that the idea? You said inflation, recession, anything else? Coldplay, the rugby, it's going to be a great week. Enjoy it. How are we feeling? Well, it really depends on where you sit. I think one of the interesting things is we do a survey of investors, and we just did one 2 months. It's been 8 weeks since the inauguration, 8 weeks. And in this survey that we just conducted, 90% of the investors we surveyed, who were largely US, had lowered their forecast for US GDP growth by at least 40 basis points, 0.4%. We ourselves, since the beginning of the year, have taken our forecast from 2.4 to 1.7%. So 70 bips. So you've seen a real decline in the view or the outlook of US GDP growth. Now, there's a difference between a decline and a recession. So I'll just deal with the R word. We are not suggesting there will be a recession. In fact, we see the odds of a recession as around 20%. If you had landed from Mars and you were just trying to predict recessions in the US come and go every 7 years or so, you'd have been at, say, 15%. So essentially, we attach relatively low odds. We're not saying it's impossible, but low odds of a recession. But what's going on here is really two things which are, I think, on the minds of investors and depending on where they sit. One is trade, brackets tariffs, and the second is, of course, geopolitics. And then there is a third when you sit here in Asia, which is, of course, of domestic China, which has a massive effect on so many of the economies in this part of the world. But if you just take those very quickly, on the tariffs front, we are seeing a shift. The rhetoric during the campaign in the US was all around China, and it was all around a universal tariff that was going to hit everybody. Fast forward 8 weeks, and just as a side note, it took the Trump one administration 2 years to get to tariffs. We're at 8 weeks. And we're now talking about country-specific tariffs. Colombia, Mexico, China have already felt the heat there. And let's remember, China's already facing an extra 20%. It's manageable, but it's material. Country tariffs, sector tariffs, steel and aluminium, or aluminum, for those of you who care to mispronounce it, 25%. And then if you go from there, you've then got reciprocal tariffs, fair and reciprocal tariffs, which are coming on Liberation Day, April the 2nd. And those reciprocal tariffs, we don't quite know what they'll look like, but they're going to have an impact. And it matters to this part of the world a lot, because if they are premised on trade imbalances, let's just remind ourselves that on the list of the top 10 trade imbalances with the United States, number 1, China, around $285 billion. Number 2, Vietnam, $123 billion. And then you start going on from there, Taiwan, $84 billion. Japan, $74 billion. South Korea, somewhere in the high 60s, and you end with India. So you immediately start to recognize that if you're an investor sitting here, you're going to have to factor in how these tariffs impact Asia in particular and those countries. We don't quite know how they will. So tariffs and trade, big on the mind, and they weigh heavily because they have consequences. The second element, of course, is geopolitics. In a strange way, it feels like it's second at the moment, particularly in Asia. But let's remember there were a whole series of alliances, that are under pressure or at least being questioned. Some involving small numbers, AUKUS and the Quad being examples of the trilateral, which includes Philippines. Others, many more. For example, the Indo-Pacific Economic Framework that took place with 14 countries. And so the geopolitical alliances are also leading to question. So what does that mean? It means we're dealing with a lot of volatility. It means that that volatility, while it can be traded, is unsettling. And if you measure it in one sense, the VIX, one measure of volatility, it's back to levels that we saw just after the Russian invasion of Ukraine, which gives you a real sense of the uncertainties that everybody is grappling with. And so with the volatility comes those who feel they can trade it, but also a lot of nervousness. And it's accentuated by questions then over the domestic economy in the US, talked about recession, but also in China. And perhaps that's where you see a little more of the optimistic side coming in. Because in China, we've talked about the 3Ds. Everything comes in threes: debt, demographic, and decoupling. Now people are talking about, well, restructuring of the debt. Seems that China's getting to grips with doing that. We're going to hear more about bank recapitalizations. A lot of work going on there. We're hearing more about reviving consumption. They had a consumption plan that you saw come out a week ago on Sunday, which is now more than just cash for clunkers. There's something to it, and while it's still high level, it's the right conversation to have. And then the one that many investors care most about, confidence, the animal spirits of China. And that's actually where I would put DeepSeek. To me, DeepSeek was a shot in the arm for those looking to see confidence return. The picture of President Xi, I used to say, somebody asked me what would be the big thing that would revive confidence in the private sector in China. I used to say a big hug between President Xi and some of the private sector leaders. Well, we got a handshake or two a few weeks ago. Mm-hmm. But confidence does feel like it's returning. You put all that together, you start to see a bit more optimism in this part of the world.
So you unpacked a lot there, and I'm going to go to Aaron on the point of volatility. Do you embrace the volatility this year? Is this a year where people go risk off or risk on, or really just ride the wave?
Well, I mean, look, as long-term investors, you have to embrace volatility to generate long-term returns. So we shouldn't be shying away from volatility. But I think the key to navigating all the uncertainty that was just discussed is actually to have a diversified portfolio. And it's actually been painful to have a diversified portfolio for the past 2 to 3 years when US equities are going through the roof. But right now, the global equity benchmark has never been as concentrated in the US as it is now. The US has never been as concentrated in one sector as it is now. And that sector is concentrated in a handful of stocks. And so, given all the uncertainties and the valuations, you want to have a diversified portfolio. You want to, in some ways, yes, be underweight the US at this juncture. And you're starting to see that rotation so far this year. US equities underperforming, non-US markets outperforming, the dollar actually weakening despite what was supposed to be a one-way bet. If Trump does tariffs, dollar goes up. That was already priced in. And so I think that's a key here. And also this whole US-China debate, like when I talk to global investors, so much of the time is taken up by talking about China and what risk does China have. But China's weight in the MSCI All-Country World Index is barely 3%. You have single stock exposure to Apple, NVIDIA, Microsoft of 4%. So the single biggest risk factor in most people's portfolio is US tech. And if
That's the headline. That's the headline. That's a key takeaway.
Yeah.
Janet, do you agree?
I would say that investors really need to think about where are your unintended risks, and I think being really aware of that. So I think just taking a step back as we think about the world that we're in today. So we're in a world where interest rates and inflation are likely to be structurally higher and more volatile. So the cost of capital really does matter. And then as you listen to Kevin, political intervention and also global dispersion is also going to increase. So diversification will matter more, as what Aaron said. So just really anchoring to some key fundamentals. And then I'd say the third thing that's happening is broadening. So we talk about US exceptionalism, but we are seeing some broadening starting to happen with China outperforming this year, Europe as well. And so if you think about those fundamentals starting to catch up from a sector and market perspective, you really need to think about your starting expectations. So growth has always mattered, but what is the expectation for that growth? So getting your valuations right will be really important on a go-forward basis. And so on the US side, I think we've seen a lot of flows into passive, S&P 500, that was absolutely the right decision. But if you think about the concentration there, how do you think about neutralizing that, and what what decisions are you making around that will be really important.
You mentioned active management. It was interesting because in our pre-panel discussions, all three of you, Aaron, Janet, and Hal, emphasized the importance of active management. Hal, let me get to you. You were saying that it's no longer central banks calling the shots anymore.
Yeah.
So what do? I know that you want to stay active.
Yeah.
What else is on the table?
I think if you look across the panel, the things that we're talking about, what's happening in the US with tariffs, 2nd of April, we're all waiting for it, what's happening in Europe, and what's happening in China. I think the thing that kind of stands constant is policy activism, right? That the baton has shifted from monetary authorities to fiscal authorities and governments in general. And the problem with this is I think many of us in the markets in the last 20, 30 years, we're used to Fed watching. We're very used to understanding what growth is. We're very little understanding of what inflation is, right? We're very good understanding of what central banks will do, but it's very unpredictable to know what fiscal authorities will do. You look at Europe, right? We had what the Bundestag has kind of gone through, and then the next thing we know is that there are a few countries that can't get through. So policy activism is a new mode of operation in this world. The other point I think Janet has pointed out, the other underlying diagnosis over all these symptoms that we're seeing is obviously interest rates are not going back to ultra low rates, right? And this is the symptomatic of what Kevin has said about actually the US, while it may slow, there's some growth moderation that he sees, it's not a severe recession. Private balance sheets are okay. Consumer balance sheets are still holding up. I mean, it can turn weaker, but it's not something that we're thinking about. Interconnectedness with the banking system, issues with corporate margins are not there. The loops with feedback loop with labor market is not there. They're not having to cut the bottom line. So all these are positive from the US economy point of view. It also means that the Fed, while they can cut rates, they're not going to go zero. All these have implication around volatility, discount rates, multiples, in thinking about forward-looking returns assumptions. So I think the base view of thinking about interest rates, thinking about how policy activism has changed, and some of the economic linkages that we're talking about, be it between Europe and US, China and US, these are the underlying drivers that we're seeing every day.
So the takeaway, for me at least, it seems to be that there is no recession. That's not what data suggests. But it's time to stay diversified and active. Well, what about the valuations of Mag 7? I mean, don't they look a little attractive at the moment? I mean, some are saying that the Mag 7 valuations are now back to ChatGPT moment. So now is not the time to pick up on that? I mean, I'm not going to name one person here, but anybody who wants to pick up on that. There's no recession, then why not buy the dip?
Well, that's a long-term strategy many have taken, and we'll see. I mean, you know, the Magnificent Seven, one of my colleagues called them the Maleficent Seven, from magnificent to maleficent. And the idea was simply that, as you had said rightly, that there has been a shift in the valuation outlook. The question, I think, is less around technology and its role, because we could debate forever just the extent to which, for example, DeepSeek or others of that kind change the demand for compute. But the direction of travel and technology remains upward. And let's not forget that the rally in the Hong Kong market here is a technology-driven rally. Whilst it has broadened somewhat, the Hang Seng's up 20, Hang Seng Tech is up 30. And the optimism around China is that there are many other technology innovators coming, whether it's in the areas of robotics, which I think the world is yet to see the full impact of Chinese robotics, or it's going to be in the application of technology to biotech and bringing more to fruition there. It is a tech-driven future. So I'd be cautious about extrapolating too far from the moment. You can talk about the individual stocks, I'm not going to do that. But I think the general message is a difficult one. Because consumption is the other part of the equation here. And the real issue, for example, in China is going to be, can the consumption be stimulated at a level that offsets some of the broader challenges that an economic model that relies on exports demands? And that, I think, is a bigger question that will have more ramifications for the Chinese domestic market. But tech, I'd be very wary of selling off in tech. There's a lot coming still down the pipe in tech. And it's yet to be seen which of the companies will benefit, but there's more to come.
You mentioned Hong Kong as being very profitable, at least year to date in terms of the market performance. You mentioned Hong Kong. And Janet seems to like Europe as such diversifier. So just give us your take on what's happening in Europe. It's been moving, and it's been generating some profits here. Is that one of your biggest diversifier in 2025?
Yeah, we're generally seeing more interest from clients in Europe because things are shifting there as well from a regime perspective. The fiscal policies are starting to shift a little bit more in Europe, probably more domestically focused, thinking about security and defense spending and things like that. And so from that perspective, we're actually seeing more interesting areas in the value sectors in Europe. So thinking through financials as an example. I would also say defense spending, as I said, I already mentioned that, and utilities and telcos and other areas that we've been finding interesting opportunities. And then I would say small cap. So, if you think about active management, we kind of think of where is market efficiency and thinking about frameworks around diversity of markets, where there's consensus trades and things like that. And the US market is a very efficient market, so passive has probably been the best way to play that market, as I said, in the last couple of years. But areas like small cap in Europe is also another area that we're seeing a lot of interest. And then I would say from a credit perspective, we're also seeing Euro credit as a good diversifier to US credit. If you think about the Euro-US asset base, there's obviously a trade imbalance, but there's also a capital imbalance as well, right? So a lot of European savings in US financial assets. As tariffs start to come into play, as fiscal policy is starting to change, as more of the private companies are starting to think about just saving, will that flow go back the other way? That's another, and you can also pick up yield now on a hedge basis as well. So that's a shift that we're watching closely as well.
And Aaron, what do you like in non-US international markets? Because you generated this big headline. I mean, US tech, stay away. Now, what do you go after?
Well, again, just to be clear, you have to have some exposure to U.S. tech, but do you want to have the benchmark exposure because of the valuations and just how concentrated it is? And actually, all you need is U.S. retail investors to start selling S&P 500, and mathematically, those stocks come under pressure.
There we go.
So it's even, we can take the fundamentals to some extent, we can take the debate over the fundamentals out. If you have a declining risk appetite in the U.S. and the retail sector, those things come under pressure. And so yes, Europe is cheap. Parts of Asia are cheap. China is attractive. And what's interesting about this China rally, as Kevin was pointing out, yes, it's been tech-focused. The A-share market hasn't moved much. And the A-share market is really sensitive to domestic policy and animal spirits. So the true test for whether the animal spirits is coming back in China, whether the private sector is really feeling empowered in China, is when the A-share market starts rallying. And when that happens, then China equities can go much higher. Global investors have not really been buying the China rally yet. Most of the inflows have been from the mainland, southbound. And so I think we need to wait for that. But yeah, I think China's attractive. Most active managers are underweight China. So we're very neutral and constructive on that. There's Europe. The areas that are expensive, actually India and Taiwan are quite expensive markets. And India has started to roll over for its own domestic reasons. Growth expectations got too high. Yes, it's still a strong growing economy. When expectations get out of line, market sells off, and Taiwan has been a massive beneficiary of the semiconductor and AI theme. And so again, if that starts to roll over, those two markets in EM can start to underperform.
What do you think global investors are waiting for to get into China A shares?
Well, I think it depends. You have to segment the global investors. I think the reality is there's tremendous pressure on U.S. investors to stay away from China. And again, I think until they see more confirmation that the economy is revving up and that the markets are going up, but there's a lot of pressure there. I think Europeans are in the middle. And I think Asian investors are the ones that we really want to see step back in. And there's an opportunity there. I think the same goes for private markets. I know we're not talking about that yet, but I mean, as U.S. investors kind of pull back, it creates these opportunities for non-U.S. and Asian investors to fill that gap. And I think that's the real kind of opportunity for a lot of you in the room today.
I saw a very eager look on Kevin's face when I asked the last question.
No, I don't know about that. It was an eager thing to try and avoid giving an answer. What are they looking for? Look, I think I agree with Aaron. First and foremost, some clarity around the framework by which they can be part, particularly if you're from the US. So the America First investment policy sets out a high-level fact sheet, but it doesn't really, at this point, give clarity as to what that really means. And so I think definitely waiting to see how that goes. Definitely waiting to see if the geopolitical connections can be strengthened in a way that is conducive to really being confident that you can get money in and get it out. And thirdly, also just some sense of how the underlying economy in China really is performing. I couldn't agree more with Aaron. The rally in CSI 300 is all of 1 or 2%, depending on your start date. That's very different than what we're seeing here offshore in the Hang Seng and the Hang Seng Tech. So those three factors, together with consistency, investors want to see a consistent approach on the part of China towards the private sector predominantly. So there's quite a few pieces yet to come together before they're going to feel confident about jumping back in. The one thing I would say, though, and we've seen this in some of the IPOs that have taken place, but they're in Hong Kong, and we've seen it also in the follow-on offering from BYD. You have seen the longs, the international investor, be willing to go into those quality names with real prospects. But as a general return, those 3 or 4 factors need to be in place.
How do you want to add to that? Do you like China, or do you have any other markets that you're eyeing this year?
Sure, I'm going to talk about something boring. It's not the exciting equity markets that you talk about in China or in Europe. A simple way is to hide away from all this macro vol, is to stay in fixed income and credit. Yeah, this is a world where you saw interest rates have fallen continuously for 40 years, right? We've seen this rise that we've seen over the last 3 years. These are level of yields that you're going to see. It's equity-like returns in the very long run, right? The absolute level of yield. Even if you think about defaults, possible defaults, think about US high yield, 3.5%. Even if you take that level of defaults in a recession that we don't think is severe, it's going to be more than compensate what you're going to get in US high yield, 7-8%. It's going to give you that return, right? And what more, as fixed income investors, you're ahead in the capital stack. Contractual obligation, you're first to get paid. It doesn't matter, Hang Seng is going to go 20% down, up 20%, you're going to get paid as long as the company exists, right? So from our point of view, this is the time to be hiding away. Things are expensive in many parts of the market. You have to deal with the vol. Doesn't mean you go all in, but there is a meaningful allocation you should be thinking about in this world where the world is complex. There are many undercurrents in it, and I think this is the place to be. Be boring, basically.
Be boring. How boring do you want to get? What's the good ratio?
Well, I think you think about what is that risk-return framework, right? If it depends how much risk and stance you want to be taking in being aggressive. There is a time for that, right? And now, potentially for us, it's probably not the time. You want to be in income, you want to be in credit, and think about what happens. You know, it can very well change in the second half of the year. I know now we're thinking about the US exceptionalism going to kind of go away. Things change very fast. It's been 2 months, 3 months of us sitting here excited about November 6th, and we're here thinking the world has completely flipped upon us, right? We're day to day in, day out, we're swung by the markets. But think about it, second half, tax cuts, extensions come, BREC comes, that whole story can turn. And China has a wide policy arc. They can't turn immediately. The POE turn is real, but the deflationary pressures around property, around the local governments, is going to take time. They're going to be reactive, not proactive. And the stance has completely changed, but they can't go about to go turn because the policy framework and the political stance, it doesn't work the same way as the US, right? You get a new president, you change. But in China, it doesn't work like that. So expectations can move very quickly.
Yep.
Money flow is fast. We've got 6-7 trillion sitting in money markets. That money will move in and out, right? Either you play the swing month to month, day to day, 2nd of April or not, or you think about what is the allocation that you need to sit through, right? While you have part of allocation trying to move with the markets.
Great point. So stay boring. But not so boring, this conversation for sure. And Janet, I'm going to go to you for this next part of the conversation, which is public converging with the private markets. I love the way you put it. Why is it important to be at the intersection of public and private markets to generate alpha?
Yeah, so private markets are definitely growing. I think one of the stats is, in the US, if you think about 87% of companies with revenue over 100 million are still private, right? And so, 20 years ago, I'd say that dynamic is increasing as more companies are staying private for longer. So for us to be able to do a really good job for our clients, we have to actually have expertise going across both public and private, and the ability to value those things across that ecosystem. So when clients come and talk to us, they're sort of asking a lot of different questions on how you think about this convergence and how should we be allocating. So really thinking through frameworks for what does that allocation look like. The normal mean variance risk return structure really doesn't work in thinking through that. But also some of the more exciting opportunities are still in the private markets. So if you think about areas like biotech, and then AI technology, climate technology, those areas are still there's a really good opportunity set in the private markets. Other ways that clients are asking us to sort of think through public-private is if you think about fintech, and because the ecosystem that we work across, having investors on both sides, if you're thinking about fintech companies, it's really good to get a sense of what would that journey look like if they became public and what the valuations could look like. And then even from a credit perspective, as we're working with our insurance clients, they've got sort of their investment grade credit, but if they want to pick up a bit more yield, they're looking at sort of the private placements in the investment grade market. So I think that's, for us to be able to do a much better job, we need to have expertise in both because that ecosystem is becoming such an important part of the overall universe that we work in.
And Aaron, you had some insights about how the money is flowing in terms of the private markets. Maybe US is a little, they've had their game with the private markets. Now it's Asia's turn?
Yeah, I think there's many large U.S. investors are technically over-allocated to private equity at the moment. And given the weakness in the IPO markets, the distributions from private equity have dried up quite a bit. And so for large investors, you're using the distributions to fund the new commitments, and when those distributions dry up, by definition, you need to pull back a bit. And then you have this uncertainty, what's going on in the market, everyone wants to have a little bit extra liquidity. That was the big lesson from 2008. That liquidity is king when you need it, and so especially if you have a lot of private investments. So you have had the U.S. investors stepping back, and this is even to U.S. funds, not just China. In general, there's been a pullback there for the needs to reallocate or deal with liquidity. And so that, again, creates an opportunity for Asian-based investors to get access to U.S. funds that maybe you couldn't in the past, or maybe access was constrained, and they're actively, also U.S. GPs are looking to diversify their investor base, so we're increasingly seeing them come to Asia. And in general, Asian investors are less allocated to private equity than the U.S. So there is scope here to increase without getting over-allocated. And so I think that's a trend that's going on. Another trend, not to derail it a little bit, is back to the being boring. I would say just being defensive. I think hedge funds we're also seeing coming back.
Hedge funds?
Yes, particularly low beta, low volatility type hedge funds. Those allocations have been falling for years. They're now starting to pick back up. And I think 2022 was the key year for that, when equities and bonds were both down. The only asset class that was really up, aside from the US dollar cash, was a diversified portfolio of low volatility hedge funds, which are actually positive. And so in this environment of increasing uncertainty, maybe equities go up, maybe they go down, you don't want to take a lot of directional beta risk in both equities and credit. And so I think hedge funds is another area where people are saying, I can still get decent return here without, kind of de-risking my portfolio, but it is being more defensive.
I think that's very interesting. Very unloved for some time. Janet, you have a smile. Do you have
No, I think it's really interesting that you talked about, because with uncertainty and not taking a directional bet, one area that we're seeing a lot of interest in is extension strategies, where you have the ability to sort of, given the concentration in some of these indices and benchmarks, you have the ability to neutralize that by taking advantage of extension strategies. So that's kind of an area that we're seeing a lot of interest in, because it gives you the ability to take, as things are broadening out, while you're still trying to work through the concentration at the top end of the benchmark, extension strategies are a really good way to, for clients to get more pickup.
It's this, I think this search for stability, it leads you down a couple of paths. One is to find entities that have higher earnings. So we're seeing some of the players like healthcare has been a beneficiary of that. And the other, let's not forget that if you really are searching for stability, then gold is up 16% over the last year. And the flip side of that is things like oil, WTI down 7%. So there's quite a reminder of what stability can look like. You tend to get the real assets coming through. And I think as a leading indicator, whilst it's the case that the premier funds have been able to conduct fundraising successfully in Asia, it's worth reminding ourselves that if you look at fundraising, which might be a bit of a lead indicator, it was pretty grim last year. Private equity was at levels that we haven't seen for 7 years. Private credit was back at 2019 levels. Real estate, let's move on quickly before we wallow in that one. And the only place where you really saw a big pickup in fundraising was infrastructure in Asia. Infrastructure was well up, 4 times the previous levels. 2024, 4 times 2023.
Is it mostly data centers?
It's a lot of things. Data centers part of it, although there's some concern they're getting overbuilt now. But it was the logistics. It was the whole reality that Asia still has a hunger for infrastructure build, and that remains quite a lucrative space if you can access it.
How?
I was going to add from a macro perspective, I think we talked about interest rates not going to zero. This is basically the tide that lifted all boats for a long time. It's not going to happen anymore. And that's why we're talking about hedge funds, we're talking about alternative credit, we're talking about ways to get individual names in the portfolio. Private credit is a great way to kind of get that. I think the lines between private and public credit are going to blur. Eventually, it's going to be outcome. What you're trying to achieve at the end of it, be it a sector rotation, sector exposure that you need, be a certain level income that you need. It does not matter, because as long as you understand the liquidity spectrum or where you're trying to hit risk amount of return that you get excess return on top of public credit, that's how eventually investors will have to think about it, than to think about it individual asset allocation to it. So this is the world, like we were talking, the structural trends that underpin some of this will take a long time to kind of unfold. Same for hedge funds, right? When passive was great, and active management and hedge fund, if you see in that spectrum, this thing is going to reverse when rates are going to be at 4% and not at 0%.
Interesting. It was briefly mentioned, but I do want to get into private credit because, I mean, it's just becoming most talked about, hottest asset class. But I'm also seeing reports suggesting some accounts from the industry that this liquidity is chasing after fewer deals, and maybe it's mostly on the corporate financing side of things. But is there something that we need to worry about? How do you guys feel about private credit at the moment? Is it getting a little crowded?
I'll take the bait.
Aaron?
Yeah, I'll take the bait. Yeah, I mean, so private credit is an asset class here to stay. It's structural because banks are pulling back in the US and Europe and even in Asia. But it has attracted massive amounts of capital. And it is getting crowded. There is a chase for kind of spreads are tight. There's a chase for deals. And, you know, I think investors, what concerns me the most is some investors think that private credit has no risk. They think it's just, oh, because it's not mark to market, it's low volatility, it's just extra yield and there's no risk. There is risk in private credit. And if you have a credit cycle, it will be there. And so I think investors need to be very careful. They should still be investing in private credit, but again, I think manager selection, and also just really understanding the risk and where in that private credit spectrum you want to be is important. And you know, they say they don't ring a bell at the top, and I may get in trouble with one of the sponsors for saying this, but you know, there was a private credit ETF launched recently.
Yes. How do you price that? I mean,
well, I mean, just
I
the idea
won't
that
understand even if you try to explain it to me. But
well, I mean, we can talk about that later. It's just you know, you said the blending of private and public, the fact that you can trade private credit intraday now. It's kind of oxymoron, but you know, I think that shows just how mainstream it's now become.
Janet?
Yeah, I mean, there's definitely parts of private credit I think are really interesting, and it's obviously a growing market. That trend is going to continue. But sort of the regime that private credit, that's shifting, you know, higher interest rates, underwriting standards. I think manager selection is absolutely key. We are seeing a little bit of broadening in private credit markets, moving away from leverage credit into more different types of collateral, so that could be good as well. I think the key also is regulation, right? As we're thinking about that, obviously from a banks versus private credit perspective. So that debate continues, so more to come there.
It's a very early stage in its development.
Yeah.
I mean, it's a small part of the market. It's massive, but it's 5 to 7% if you sort of look at it in terms of the overall credit market. So it's still a very small, some would argue nascent, yet to be fully regulated, and with players coming in. So for example, Goldman Sachs has recently extended it. We're already in the market. We've extended our commitment to it. And we did that because we believe that origination, so actually finding the right deals, will be an important part of this, but also in the expectation that there will be a credit cycle, and the quality of the holder will therefore matter, that there will be regulation. Whether it starts in the US or somewhere else, I don't know. But it's going to happen. And as that happens, you're going to see a shakeout or a change in the way in which that market is operating. And I think that's yet to come because we're still actually in the early days of the private credit market.
How?
I was going to add from a short-term and a medium-term perspective. Short-term, private markets, just like any other market, is going to go through a credit cycle, right? The question is, we haven't really been through that. How is it going to turn? And the issue is often not about whether the market is going to turn, but what we're paying for it, right? I mean, if the excess returns that you're going to get, like I mentioned, is not enough, then you won't be able to cover some of these credit losses that might come in the downturn, just like any other market, right? Equities, fixed income. The other part on the medium term, I think follow the money. Follow the money in terms of, I think at this stage, it doesn't feel like systemic, right? Even if anything happens, it's not interconnected like what we have with the banking sector, previous financial crisis that we have seen, right? It doesn't feel that way. The money flow is not synthetic. It doesn't get replicated elsewhere. So that part of it, I feel comfortable. I mean, I'm coming from a macro investor, right? Looking at it from a public fixed income point of view. The other thing is then leverage. Is it taken leverage in multiple levels? And hence following the money or where, at what stages it gets leveraged. Does it go to the bank, get synthetic, and then you get it out, you tranche it out, get a different level of rating, and then you get leverage on it, right? That is the world that we will be worried about, but we're not there yet. And therefore, on that point, it has a lot of more growth to go, I think. And it just needs to go through that credit cycle. And by that time, when it turns, I think you're going to get a much stronger and robust market because the strong ones stay and then the weak ones fall out.
Okay. We covered a lot of grounds there. I've got just about 8 minutes to go, and I'm really good with the timing because I do live a TV. I do want to get your final words, but I want to make it more actionable for our audience here and viewers out there. So, Hal, let's start with you.
Yeah.
Your high conviction calls of the year, or something that you just have to avoid this year.
I mean, as I said, I think stay boring. I think I would talk about what we are looking out for that's not really priced in, I feel. I think the mix of how tariffs and the entire situation, what we're looking for, because the base case that we're underpinning all this is that there's no severe US recession, and we could get it wrong. And everything that we said could unwind in terms of what it means for the Fed, because right now the Fed is taking a back seat. It's definitely not proactive because it doesn't know what's going to happen in June or September, right? The market wants to price that 2 or 3, whatever you call it, but we're not going to 1% rates, right? And therefore, that is going to be key. Whether it's true that we understand what that private sector balance sheet in the US is really about, and it seems like it's right, but I worry everybody is taking it as the base case. And I think that's the biggest risk for the markets. Whereas I think the China story is going to be cyclical. There's a larger structural trend that has to happen. Europe is actually the opposite. I think Europe is structural, but it just takes a very long time to get to that end state. And meanwhile, this too happens, the US growth and whether we're going to go in a recession or a moderation is going to be key in what we're thinking about.
Kevin?
Stay invested and stay diversified. You know, I think the issue is often, you know, people see the correction and they think they can outsmart the market. I've learned over the years that's not such a great strategy. There are others who can do that. I think stay invested, of course, depending on where you start from, I should say. And secondly, I do think we are seeing more diversification. That doesn't mean you ignore the US, by the way. I think the big mistake in all of this is to take the overreact. You know, just I think sometimes we overreact to noise in this part of the world. We're sort of used to it because we live here. We know it's going to be volatile. Maybe we thought that would just not happen in the US and it'd be a straight, solid line only going upwards. It's going to have its moments, but I wouldn't bet overly against the opportunities that continue to exist to get very good alpha in the US, and I think that will continue. And I also believe, being aware closer to home, there's plenty of opportunities in Asia, and I think those are now coming back into focus as people, at least, notwithstanding what I just said, take a more global view of where those opportunities are.
I'm going to build. I mean, it is high amounts of uncertainty, so staying invested, staying diversified, and being conscious of where your portfolios are, like the unintended risks. So passive has seen a lot of flow, but there's so much concentration in these benchmarks and indices. That can lead to some issues in the future. So I think just being really aware of those risks. I also agree, I think a market, Japan it continues to be an interesting market. It's an area where we're seeing a lot of interest from our clients as well. So yeah, being diversified and thinking through the opportunity sets that people haven't been really focused on.
Aaron.
All right, without
And don't forget the teaser you're supposed to do
yeah.
for the upcoming panel.
I mean, look, I agree with the colleagues here. I think this is a year where the uncertainty is rising. Maybe a recession is only 20%, but I think last year your prediction, the probability of recession was much lower. So the delta of that is rising. And so therefore, yes, you need to stay invested as long-term investors, but you need to be modestly defensive and make sure you understand the risks. And so our view is modest underweight to US, modest overweight to non-US, modest overweight to value. Expect the dollar to be very volatile, and then yes, seek these kind of low beta strategies, such as whether it's credit, low beta hedge funds, and this is how you're going to survive, and just test your risk tolerance, because there will probably be a much larger drawdown this year, but what happens after that is anyone's guess. And so the idea is to stick to the investment strategy and not panic when the volatility spikes.
Yeah, so I wish I had my pen to take notes, but stay diversified, stay active, but don't forget, don't rule out the US just yet. No recession just yet, but stay boring, right? So yeah, it's a lot there. But I do, so what I meant by teasing for the next panel, because we wanted to touch on AI really quickly, just because it's such a big narrative of playing out for the markets. I know that you guys thought that you were done, but just quick lines on artificial intelligence. I know that Kevin touched on China's a DeepSeek moment, but how is this going to impact what you guys do and your portfolios really quickly? Let me just pick back up from Hao.
For us, the important thing in China for DeepSeek is not about the 6 million versus 5 billion. It's about the democratization of AI. Open source is going to change the game. And that means China and Europe potentially has a chance of what goes on with the US. That's what we're kind of looking out for. When the game and playing field is a lot more level. And because China and Europe works in a different way from how US, you get funding, you keep pushing. But for China, it's about commercialization. It's about getting to where you can monetize. And so that's the game that we're thinking about that could be meaningful.
Okay. Kevin?
It's a very overused phrase. There's a lot within AI. We should unpack it. We should talk about the different parts of AI. The reality is we're going to shift from the hardware era to the software era to the apps. You've got to really look at all the different points in the chain. There will be a lot of money made. At the moment, it's been made by the hardware suppliers. Maybe now we're beginning to see that transition as we start to see the applications that will really make a difference. To me, maybe that's the word democratization, as Hal points out, because that is what DeepSeek really took. It showed a lower cost way to do things with high cost equipment. And I think in the transition that takes place, it's going to have a very fundamental effect. So yes, AI is going to change the way we operate. We can already see that in our bank, in the way in which we're applying it, whether it's to the engineers who code, or to that matter, the way in which research is done. There's a lot of change coming, but change takes time. And I think if anything, it's going to be the old saying that we underestimate what's going to happen over a decade and we overestimate what's going to happen over a year. The question is, at what point does that flip? Let's see.
Okay. Janet?
So AI, it is a paradigm shift. I would say, there's a lot of noise around that, but our fundamental investors are still really excited about what AI can do, and then really thinking, the questions are around the CapEx around AI, and when does the return on investments accrue there? Will there be a broadening of it? We're still kind of focused on things like enablers of AI, the apps, that's another interesting way to play, and then also the cloud as well. So lots to watch there, and I think it's just really sort of thinking through also the broadening of that, as I would say. And then from a business perspective, we are really starting to, I'd say we're early, but really doing lots of pilots on how we want to incorporate that into our business.
And Aaron?
Yeah, I have 38 seconds.
Yeah.
Look, AI is a long-term trend. It will have big impacts. But the real impact from AI for society and markets will be the adoption by companies and the benefits they reap from it. The current crop of companies that are now dominating the market, that are the beneficiaries, may not be the long-term beneficiaries, just like in the tech bubble when Microsoft was also one of the largest stocks and then for 10 years went nowhere. So AI is a theme, but the current winners may not necessarily be the future winners.
Yeah, so again, stay active, nimble, and I feel like I just learned so much. It was just a lot there. I'm going to go back and listen back, but thank you so much for speaking to us today. Thank you. Thank you for listening.
Thank you.
Thank you for joining the Global Investors Symposium.